Negative gearing is a common term in property investing. Let's break down how this tax strategy works for rental property owners. At its core, negative gearing happens when the costs of owning an investment property exceed the income it generates. When your mortgage interest, maintenance, and taxes are higher than your rental income, you are operating at an annual loss. These deductible expenses are subtracted from your rental income to determine the final tax position for the investment. Investors choose between these based on whether they prioritize immediate cash flow or potential long-term capital gains. In this example, the $8,000 difference can often be deducted against other income, reducing your total tax bill. Always remember that relying on tax deductions alone doesn't make an investment profitable if the asset value does not rise. Tax laws are complex and vary by region. Consult with a qualified tax professional before making investment decisions.